are you?
Very good, thank you.
It's getting a little dicey. That's what you're saying. I think it's probably underestimating things, yeah?
It is a bit dicey, both in terms of the debt issues in the US. It now seems like we're probably not going to get an agreement before August 2nd, which means that the uncertainty will just last longer into August. Trading is very thin during that time. We get a lot of headline risk coming in during the month of August as well. Plus, economic data is not looking too reassuring as well.
Yeah, let's talk about some of the economic data closer to home. We just got South Korean GDP figures this morning, pretty much in line with expectations. But I guess when you look at the top headline on the Bloomberg terminal, they're saying that growth is slowing. But what about the economic headwinds that you talked about globally? Does this number seem to be in line with your expectations?
It's really backward looking because it's the second quarter. If you look at trade numbers, which is really where you find the headwinds really gain traction, that seems to suggest that we're going to see a deceleration of growth. So Taiwan, for example, which is very sensitive to the global tech cycle, is already seeing much weaker numbers coming out. Korea is a bit better shape because domestic demand is resilient. You have retail sales still going strong. But overall, it seems as if the trade cycle continues to weaken because U.S. demand is just not firing up as quickly as it should.
Mm-hmm. Well, I mean, corporate US is doing very well, isn't it? I mean, we've seen these very strong sets of profits coming through.
77% of companies have beat so far that reporting.
And it's top-line growth. It's not bottom line, but it's not translating into jobs. The companies are hoarding cash, more or less, and they're making most of their money abroad. What gives?
Yeah, I think it's because they make their money abroad. So most of the revenues, profits are now coming from emerging markets. That's where the growth is. They're not adding jobs at home necessarily. And the other thing is that companies are still shell-shocked in some ways from the global financial crisis. So nobody really wants to add jobs in an environment where, you have a debate about debt default, the U.S. government, there's still deleveraging pressures in the U.S. So I think the corporate world is still very cautious in terms of adding jobs, and that's weighing on consumer spending in the U.S.
Yeah, we were talking to the head of emerging markets yesterday from JP Morgan Asset Management, and he says, actually, if you take a look at the exports, it's actually more domestically consumed these days. So do you really need the U.S. and Europe really that much anymore?
Well, not as much as previously, and one of the the positive aspects of all of this is that actually slowing exports helps to ease inflationary pressures in Asia. So remember, that's what a few months ago was really the key risk here, was inflation, not necessarily slowing growth. And still in India we have high inflation, still in China needs to come down. Today in Australia we saw that inflation is actually not coming off as quickly. So to some extent, slowing global trade is a blessing in disguise.
You would have thought, with the way that the Aussie dollar is performing right now, that that does the Reserve Bank's job for it in some way. I mean, with $1 you'd think that inflation would be, and inflation expectations would be ratcheted low, but no, that's really not the case.
Yeah, and part of the reason is because you have enormous investment in the natural resource sector. It's driving up wages, sucking in employment, and that makes the job very difficult for the RBA.
5 to 6% of Australians are employed by the mining sector and what comes off the mining sector, construction, etc. there.
I don't know where you get your data from.
My last guest, Robert Rennie, said that from Westpac.
We'll check with him. Okay, but what do you think about the Australian economy and stuff? Do you have a view at all?
Well, I mean, it's a bifurcated economy. There are parts of the economy clearly suffering from the strong Australian dollar, but generally speaking, the investment in the mining sector is so strong, will carry Australian growth for the next 2 years. And we actually think the RBA will continue to hike rates, not necessarily in August, but later in the year, and continue to do so. The market is almost pricing in cuts at this stage, and we think actually we're going the other way.
I think that's going to change. We changed from a 48% chance of a cut to 16% after the data, apparently. So
there's still a 16% chance of a cut?
16.
Yeah. But still, I'm surprised that there's even any expectation of a rate cut.
But it's a general theme for Asia, actually, right? In India as well, you had rate cuts being priced in, and then the RBI delivers 50 basis point hikes yesterday. And then similarly in Korea, we actually think they're going to continue to hike rates, even though the market is not looking for that. So broadly speaking, we think the market is wrongly positioned in terms of thinking central banks are done in Asia, but they're not quite done yet.
Okay, when we look at the US, I just want to get to the US because we do see the dollar just continuing its lurch down, and with this, of course, this mood music of not being able to get a deal on the debt ceiling. What really happens with inflation if the dollar keeps on ratcheting down as it is now?
Well, it will push up inflation globally, and in part because investors will flee further into commodities. And one of the interesting things about this particular downshift in global growth, that oil prices are not coming off as quickly as you'd expect, which in part reflects a weaker US dollar, and that in turn then fuels inflation globally and makes it very difficult for the Federal Reserve.
So two things are happening. Is the US inflating its debts away and also at the same time devaluing their debts away?
It might devalue it to some extent, but the problem is everything is denominated in US dollars, so you don't get much of a devaluation
benefit.
benefit.
They get a debt deal,
You've got to get one.
at some point.
Yes.
But Barack Obama warning that there'll be high inflation if they don't get one done. He's perhaps over-egging it, but if inflation goes up, they inflate away their debts, don't they?
Well, I actually think inflation is now a negative for the U.S. So the Federal Reserve has to ask itself whether quantitative easing doesn't sort of lead to itself to shooting itself in the foot, so to speak, because it pushes up commodity prices, and that then slows U.S. growth. And so it's a double-edged sword here. If higher inflation might actually be negative for U.S. growth. So the easy way of inflating yourself out of this debt crisis is not, I think, an option that's really on the table.
Started at the top, they're talking about what's been happening with India. We've got 50 basis points. Does the Reserve Bank of India know something that, well, market commentators and economists don't?
Well, I think the Indian Central Bank is quite conscious of the fact that they haven't raised rates aggressively the last 18 months, and have probably been a bit behind the curve. And this was a
they've had 10 rate hikes in 12 months.
Yeah, but they also said inflation would come down last year. For example, last summer, they argued by the end of the year, WPI would be between 4% and 5%. Of course, it wasn't. They missed their own inflation forecast and so forth. So this was an opportunity to kind of set a marker and to knock the market over the head and say, we're hawkish on inflation. We do what's right. We hike rates aggressively. And they might not be done yet.
What is inflation? Where is it coming from, though? People say it's not just because of what we're seeing in the global environment, but it's actually peculiar to India because we have infrastructure bottlenecks, which means that on the supply side we have an issue.
Well, it's a supply side structurally which is holding back the Indian economy, but it's demand that's growing too rapidly in relation to supply. So the RBI's job is really to cool down demand temporarily so supply potential can catch up. And you have to do that with higher interest rates. And in India's case, actually, interestingly, because the economy is not very interest rate sensitive, you need to raise rates all the more to get that desired impact.
No, I was going to say, why is it that, interest rates of 8% and inflation of, around about the same level as well is, very high compared to Asian peers?
Well, you have structurally, obviously, supply bottlenecks. You mentioned infrastructure, and therefore inflation is higher. But the reason why the central bank has to raise interest rates all the more is because there's not much leverage in the Indian economy compared to, say, the Korean economy, where if you raise 25 basis point hikes, you immediately have an impact on growth. In India, it takes all the more.
Right, we were talking about India last time, talking about the inflation problems, but, everybody talks about China and the inflation problem going away. It peaks in the second half of the year. Do you really buy into that story with complete certainty?
I think we're almost there, yes. We do think inflation is going to roll over second half of the year. In fact, there are already signs that the Chinese are starting to reflate economic growth. They're rolling out micro-stimulus measures to make sure that growth doesn't necessarily collapse. So, and the near-term inflation will roll over. Doesn't mean that China doesn't have a long-term deflation problem ahead of itself.
But it's an emerging market, someone said, for an economy that's growing at 9%, 10%. What is 4%, 5% inflation? That seems to be on target with an emerging market, doesn't it?
It's broadly on target, but in cultural terms, political terms, there's obviously historical sensitivity. So the Chinese government is very keen on not letting inflation get out of hand. But the interesting thing with rebalancing in China is that actually entails inflation. So as we move towards domestic consumption, we push up wages, it does mean that China has to accept a higher inflation rate over time.
Right, so it's part of the China story, right?
It's part of the China story, exactly. And we're also seeing China now losing competitiveness as a result in some of the low-end manufacturing industries, and that will benefit ASEAN over the next 2 or 3 years. So we're very bullish, actually, on ASEAN as a result of Chinese inflation.
There's been some talk over the past couple of days regarding the reserve rate hikes that China has undertaken over the past 12 months or so. Now, in turn, there's some concerns about liquidity in the system. Are you hearing anything from any of your clients out there, any folks you're talking to?
Well, we had a short-term liquidity squeeze as the last RR hike was imposed. You saw the SHIBOR rates going up, for example, but that has started to normalize again, and we actually think there's sufficient room for another 2 RR hikes actually coming through. The liquidity fundamentally remains ample.
We have this great debate of whether or not we're overly concerned about China or not concerned enough about China in terms of being complacent. I mean, what do you worry about in terms of the Chinese story at this point, or is there nothing to worry about?
Well, we're not really worried about the short term. And I think what was interesting in markets that financial markets that are worried about a hard landing later this year, etc. That's not really the key worry. The worry is over long term, 2 or 3 years down the line, can they engineer growth without necessarily creating too much debt?
Okay,
and that's still a test they have to
I wanted to jump
pass.
in with the debt problems because debt. Yes, we talked a lot about debt.
Debt will crowbar in the US debt problem.
Yes, because it all interlinks, doesn't it? Because China is one of the largest holders of U.S. debt. I believe still the largest.
Oh, yeah.
What happens if the U.S. loses its AAA rating, which some say looks kind of...
It's a base case scenario, according to a couple of people we've talked to.
That's
actually.
right.
Yeah.
It does look likely, and until Congress comes forward with a credible long-term plan, I think they might lose their AAA rating.
But they're also saying, people, that it won't make much of a difference.
Yeah, Bob Dahl said that this morning. The chief equity.
It wouldn't necessarily. That's the thing. Because in the short term, because people expect sort of a momentous event once they lose a AAA rating.
Well, that's what
that
PIMCO says. So you have BlackRock saying
happen.
it's not going to be in effect. PIMCO's Arian saying this is catastrophic for the market. So who has it right?
I think it's not going to be a short-term major financial event.
It's an evolution here, isn't it? There's been an evolution in the way that people have been thinking about this, because a week ago you said to somebody, oh yeah, they'll lose their AAA rating, and it's like, oh my God, that's terrible. But then as the days have been progressing, it's like, yeah, nah, it's going to be fine. They've got to buy this anyway. This paper's got to be bought. China will buy it anyway.
Well, it's a good parallel is Japan, right? Japan lost its AAA rating in the 1990s, and now it has a rating on par with some emerging markets, and that doesn't necessarily mean higher funding rates for Japan. So similarly in the U.S., we could see conceivably the rating coming down, but rates being relatively unaffected. But there is clearly a long-term issue here whereby China will wish to diversify its reserves somehow.
I mean, with that said, does that basically benefit we're back to the Australian dollar and other currencies outside of the U.S. dollar?
We already see that with the Australian dollar today flying again, and I think that's going to be the ongoing story, that big reserve holders will want to diversify. And it's not just Australia now. It's you have Korea, you have some of the ASEAN economies, smaller markets, and there a small diversification move by China has big implications.
So
markets.
If we gave you, let's just say Susan gave you $10 million today.
Which I don't have.
Why'd you have to say that? That means you're hiding something.
I just want to point that out for everybody.
Check the bottom of her mattress. But where would your top 3 picks be in terms of Asia for currencies?
For currencies now, we really like the ASEAN economies in general. So Thailand with a good political
pick Thailand
story.
first?
Thailand would be one of them, because it's not necessarily well appreciated, I think, how much growth there will strengthen over the next 2 quarters, how the BOT will raise interest rates. IDR remains still a very,
So Thailand,
Singapore, Indonesia.
That's 4 now. You'd pick Singapore. We got another record high for Singapore today.
Well, it could go further. The economy is going.
He has expensive taste.
Well, I guess, we were talking, when we talking, do you remember the days when you probably don't because you're quite young, Fred. When it was 3.5 Swiss francs every dollar.
When was that?
I think that
was during your time? Is that what you're saying?
Three. I remember 3. Roughly 3. In the 70s, I believe.
Yeah, you are older than I am.
Ooh, that's a nice little blow below the belt, by the way. Yes, so I want to talk to you about something expensive, because we were talking about this all morning long, right? The most expensive bottle of wine sold. If you want to drink a bottle that costs a lot, you probably want to drink it very, very slowly. It's the most expensive white wine, I should say, ever sold, costing the new owner about $117,000.
We don't have the new owner's name, but I'm guessing that it's not a French sommelier, as it's been reported, but actually a chap called Fred Neumann.
Well, it's 200 years old. It's a 200-year-old Bordeaux.
And I'm not that old.
Apparently the owner, the French sommelier, says he'll drink it in 2017 to mark the 50th anniversary of his career. And we already know Fred is not that old, right?
No, we've established
pointed that out very clearly to you, that he doesn't go back that far in time as you do.
That's right.
Okay. Anyway, so he's a wine lover.
Humiliation is unbearable.
There's a story to tell with that.
Okay.
There are studies that show, for example, that bubbles tend to be, you can measure bubbles, the degree you have acid bubbles, so the degree that per capita champagne consumption does exceed the long-term trend is a very reliable measure, actually, of currency crises and so forth.
Oh, really? So what is that telling us now?
And the slight worry is that in some Asian markets, we have, wine consumption, champagne consumption deviate very much from the long-term trend. More red wine than champagne, so the question is, does red wine also fit into that? But generally speaking, the consumption of spirits and its acceleration of the prices you pay for it does tend to
So what is it telling us about the Chinese economy, very briefly?
That it's starting to heat up.
Oh, it's starting to heat up.
It's starting to.
And if you tell me prices of this magnitude, obviously there's some concern here that we're, at least in the wine space, paying very frothy prices.
It could so easily be corked when he opens it. That's the thing. I mean, it would be such a shame.
It's time to do some investigation, I think, on this after the show.
Bubble to index. All right. Well, Fred, thanks for dropping by. It's
Thank you.
always a pleasure to see you, and thanks for teaching us something new today.
Thanks.